Hey everyone, I'm Peter Zender, and welcome to the Genuine Learning Blog. Today we're diving into an important ethics discussion from the AICPA that directly affects how firms navigate independence in this newish era of private equity. The AICPA's Professional Ethics Executive Committee, better known as PEEC, is seeking feedback on proposed updates to the Code of Professional Conduct. And we're going to break down what some of their proposals look like. But first here, if you followed the headlines, unless you've been living under a rock, we know that private equity has started to be a major player in public accounting. Up on the screen here, these headlines are just from 2025 alone, but that influence, that PE growth has been happening for several years now, and it's brought up some real questions about audit independence. So in response, PEEC formed a task force back in 2022, and their goal was to figure out if the current ethics rules keep up with these alternative practice structures, especially those backed by private equity. Questioning, are the ethical rules designed for the types of ownership and influence that we're seeing today? So to understand why independence risks are evolving, let's take a look here at an alternative practice structure, or a typical alternative practice structure. So in a typical APS, a public accounting firm separates its attest services, so those related to audit review or other assurance services, from its non-attest services, such as consulting, tax, or advisory work. These are then operated through legally distinct entities. Now, even though they're legally distinct, if we looked at this dotted line here, typically there is an administrative service agreement between the attest firm and the non-attest entity where they share branding and marketing. The attest firm pays for shared back office functions like HR, IT, or finance, and there can even be some overlapping leadership, including board members or executives. Now, even though they have that kind of shared administrative service agreement, the ownership of each is very, very distinct and different. So the attest firm will be owned by attest firm partners. This is so that they still meet the requirements of the council resolution concerning the form of organization and name rule by maintaining majority ownership by CPAs. However, the non-attest entity, that's where private equity can make their investment, or outside investors can make their investment. And the question is, do we get some influence happening from the non-attest entity to the attest entity? So what are some examples here, or risks, some specific risks where independence could show up in this APS, especially where private equity is involved? A couple examples here. First one, investor influence on compensation and budgets. So if private equity investors sit on the board of the non-attest entity, they may have approval power over attest partner compensation or over the attest firm's budget. This could create an undue influence threat, especially if that power shapes audit decisions. The second item, shared brand and resources. So using the same brand or even co-locating staff can raise questions about whether the entities are really separate. And under the current code, this could mean that the two are considered network firms, which changes the services that the non-attest entity can offer to audit clients. Third item here, board member crossovers. So if a board member of the non-attest entity also serves on the board of an audit client or one of the PE investor's other companies, that overlap could create a self-interest or familiarity threat, even if that person doesn't directly work on the audit engagement. And then number 4, also in that third bullet point, portfolio company services. So if the PE investor owns several portfolio companies and one of them provides services to an attest client, say, an IT implementation or internal audit support, that could compromise independence, even if it wasn't directly performed by the audit firm. So these risks vary depending on the PE investor's level of influence, and whether they hold significant influence or control over that non-attest entity. It's really the question at heart here of the independence issue. So to help firms and professionals navigate these increasingly complex gray area relationships, PEEC is proposing a 3-step approach to evaluate independence in an alternative practice structure. If we break it down here, step 1, identify those network firms. So start by determining whether the attest firm and non-attest entity or any affiliates meet the definition of a network firm. If they share a brand, strategy, if they share resources, independence rules could be triggered. For example, a non-attest entity in the same network may be prohibited for providing certain services to the audit client, like we mentioned before. Step 2 is identify covered members. And this isn't just about engagement team members. In an alternative practice structure, covered members might include the CEO of the non-attest entity or board members who approve that attest partner compensation. These individuals, right, can directly or indirectly influence audit quality. And PEEC is saying we should hold these covered members. We should call them covered members and hold them to the higher standards. And then step 3, map other relationships, evaluate relationships, assess those relationships, and if a threat to independence cannot be reduced to an acceptable level, the engagement should be prohibited. Or we need to apply the conceptual framework for independence, which means identifying threats, evaluating their significance, and applying safeguards. So this framework allows for flexibility, but also we need to make sure that we document all of our considerations and our professional judgments. So PEEC has offered 2 ways forward here. Option 1 is authoritative guidance. Under this approach, the examples and analysis would be built directly into the AICPA Code of Professional Conduct itself. That means the language would carry the full weight of authoritative guidance. Option 2 is non-authoritative guidance. Here, the code would remain principles-based, and PEEC would issue non-authoritative guidance to interpret how the conceptual framework applies to various alternative practice structure and private equity scenarios. You could think of it like a living document that's able to adapt quickly if these structures start to evolve. So really, in both scenarios, the content would be similar. It's really about where the updates live and how those updates to ethics are applied. But it is your turn here. The task force wants your input by June 15th, 2025. They're asking, which approach works best for your firm? Are there gaps in the proposed guidance? What safeguards are already being used to protect independence? And comments can be sent directly to ethics-exposuredraft@aicpa.org. Again, this is your chance, your opportunity to speak up if this is an area you are passionate about. But, this is a really important topic. PE is transforming the profession. Our ethics should transform along with it. So whether you lead a firm, support governance, or just want to help, have your voice heard to preserve public trust, speak up, let them know what you think. We want to make sure we get this right, but share your thoughts before that June 15th deadline. Thank you so much for listening. Happy debiting and happy crediting, everyone.